Did you know that over 60% of Americans own stocks in publicly traded companies? And in 2024, the S&P 500, the index fund that tracks the 500 biggest companies in the US, is up 20% year to date. And if we take a look at exactly a year ago, it is up over 30%. If that doesn't sound great enough, let me give you an even more extreme example. Nvidia, I'm pretty sure you heard this name before. If you bought their stock in early 2023 with, let's just say, $15,000, that $15,000 would turn into over $130,000 right now. Nvidia as a whole went from being worth a couple $100 billion to a $3 trillion plus worth company in under 2 years. And this blows my mind every single time I think about it. So stories like this one sound like a dream scenario and most likely means that it is just easy money for everyone in the market, right? Well, as you might have guessed, if any situation is looking like easy money for everyone from outside looking in, the smartest thing to do is maybe dig a little bit deeper and do some research. So today, I'll try to do just that along with you. Let's take a look at some examples, especially the most extreme ones, and really try to understand why it is so hard to consistently overperform the S&P 500 as an investor. While the overall gains in the market might suggest straightforward profits for all investors, the reality is less dreamlike. A very significant portion of the gains are driven by a handful of large companies. Name the firms like Meta Platforms, aka Facebook, Microsoft, and last but definitely not least, Nvidia. I think everyone should realize that the broader market's performance is heavily influenced by these few companies. So of course, them overperforming and crushing earnings every single quarter kind of hides so many underperforming companies with extremely disappointing performances. Sure, it's great, or I would even say beyond amazing, if you were lucky enough to invest in one of these tech giants that did an amazing turnaround from the lows of 2023, but for the rest of the market, which many investors are invested in, it is a whole different story. If you are trying to outperform the market, here's where it gets tricky. For every Nvidia out there are dozens of other companies that are in terrible shape. According to a study done in 2023, nearly 80% of stocks in the S&P 500 underperformed the index itself over a 10-year period. Picking the winners out of that bunch consistently is where most people stumble. I'm not trying to judge people and their investment decisions by any means. I actually find the fact that most people cannot overperform the market consistently pretty understandable. Because we have to consider that even professional fund managers struggle a lot trying to outperform the market. There are many studies out there that show roughly 70 to 80% of actively managed mutual funds underperform the S&P 500. And when you look over a longer time horizon, let's say somewhere from 10 to 15 years, the percentage of funds that fail to beat the index rises to over 90%. Which basically means even the experts with all their resources, fancy technology, all the money and experience in the world usually fail to outperform a simple low-cost index fund. When we take a look at the individual investors that are not professional, the results are even more horrible, as you can imagine. At the end of the day, I think it's all about the human psychology. The urge to do something when the market is volatile can and will lead to impulsive decisions. And when you see the market overall doing so well, people get the urge to do even better, and they end up taking more risk than they would otherwise. I totally get it, you know, because I've been there, but it is more often than not a trap created by our own greed. I'm not saying that you shouldn't be taking any risk at all, but the whole reason for me making this video is that I just want you to be aware. You are most likely overestimating the chances of you outperforming the market by a lot. Most new investors are guilty of this. So it is not something to be ashamed of. If you do not have all the time in the world to research and be okay with losing a large amount of gains, especially if things go wrong, I think you should just play the long game. Keep investing in a low-cost index fund to grow your net worth, all while keeping your sanity and not stressing 24/7 about your risky investments. You know what they say, sometimes the best strategy is just riding the wave, rather than to try swimming faster than it. So that is it from me today, and I hope you enjoyed listening to me ranting about the market and all. And oh, before I forget, if you are interested in more videos just like this one, please consider leaving a like, comment, subscribe, all that jazz. But most importantly, do not forget to take care of yourself until the next time.